Welcome everybody to the webinar Trading Psychology with Thomas. I'm Thomas. I will be presenting the webinar today. Feel free to ask any questions that you may have in the question box. First of all, I will tell you a little bit about myself. I've been working AvaTrade for the last few years as a senior account manager, which basically means that I had the opportunity to work with many clients who are trading with the AvaTrade platform, and I know what are the main challenges that clients are dealing with, and I will be sharing with you today some of the daily challenges and issues that clients are facing while trading, and hopefully it will help you with your trading journey, and you will be able to learn from the mistakes of other traders that I will be sharing with you today. We will do risk disclosure, need capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, a recommendation or suggestion. CFDs are a complex trading instrument and come with a high risk of losing money rapidly due to 57% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. For the full disclosure, you can visit the website. Today webinar agenda, we will be discussing trading psychology, mindset fundamental, common mistake, emotional control tools, routine and discipline. If you have visited the previous webinars that we had, we already covered this subject once, and we did cover a few different subjects. In our previous webinar, we also discussed placing orders, closing orders, calculation of profits, losses. If you want to go back to one of the subjects that you didn't understand, you can feel free to do that. And I will be going back to the main page of the WebTrader. This is the page where when you log in to your account at AvaTrade, you'll be able to see the WebTrader page. When you click here on the left top, you can see my accounts, payment, tools. When you go to accounts, you'll be able to see the list of all account number that you have. Over here, you can click on the web trading to get to this page in case you're not already on the page of the WebTrader. Add an account if you wish to set up another real account. Some of the clients like to have different account types. So these are the accounts that we have, WebTrader, MT4, MT5, and other options. For the sake of the webinar, I would suggest to have a demo account to practice if we will be doing some things related with the trading. You can also practice on a demo and place orders on a demo if you need to have that extra practice other than trading regularly on the live. Over here you can see there is account number, the server, and your currency. The account number will be used in order to log in to the MetaTrader terminal. If you wish to log into MetaTrader, all you have to do, you can click here on the download MetaTrader button, and then the MetaTrader will be downloaded and you'll be able to click to log in. You click file and log in to trade account, and you put here your account number. Make sure you put the server if it's real or if it's demo. You put the password, and then you can log in to the MetaTrader. This webinar we will not be discussing the MetaTrader. Possibly we will discuss MetaTrader on our next webinars. Okay, I'm just sharing with you that information on how to log in, because I think this is a good tool that each one of you should also use, which is the actual platform called MetaTrader. So you can have both the website to log into. You can also use the MetaTrader. You can use the app, the AvaTrade app. You can use the MetaTrader app. It depends on your needs, because the difference between them is that on the WebTrader and on the AvaTrade app, you have features that are not available on the MetaTrader. The features that I've shared in our previous webinar, so you can go through the recording to see. But just to recap, we discussed the margin impact. This is the calculator will show you approximate amount of the amount of money required to place the order is calculated for you. On the MetaTrader, it doesn't. Okay, it doesn't show you how much money you need to place the order. Also here it shows you you have AVAProtect. This product also is only available on gold, currencies, silver, and only on the WebTrader or on the app, our app, AvaTrade app. Execute when price hits is a pending order. You can find it also on the MetaTrader. Take profit and stop loss. Also, you find it on the MetaTrader, but you don't have the possible profit and possible loss. That's added feature that we have on our WebTrader. Also here you have a lot of things that are added, like favorites, hot, most rising, most falling, most buying, most selling. If I click here, for instance, I can see different instruments that it's giving me. And then I have the categories. These are the same categories that are available also on the MetaTrader. The interface will be different a little bit, but here if we are discussing the web positions, represent your open positions. Now you have no open positions. The orders represent your pending orders. I have no pending orders. History represent your closed positions. Signals. This is by a third-party company called Trading Central. Then we have the news that you can use. Over here you can see different kind of news, and then over here you have more different features that are also available. This is our tutorials academy links and chat with our customer support. So this is just a little recap from our previous webinar. We spoke also about balance, free margin, news margin, profit, equity. If you want to learn what each one of them means, which is substantially important, also you can visit and have a look. Okay, so now we will continue with the second discussion that we are having about the psychology of trading. We have discussed it as well, one of the first webinars. If you guys, anyone have questions, again, you can feel free to let me know. So first of all, we have the mindset fundamentals. What are mindset fundamentals? We have the psychological principles that shape how traders think, react, and make decisions in the market. They determine how well you, as a trader, you handle fear and pressure, risk and uncertainty, different emotional triggers that you have while trading. So clearly a strong mindset is very important, okay, and help traders to be disciplined and to follow your trading plan and avoid emotional decisions. A weak mindset leads to impulsive trading, inconsistent results, and repeated mistakes. Even if the trader used a good strategy, the mindset can cause the trader to make mistakes. And also, if you don't follow a strategy, it's difficult to know where are you failing, because you don't keep a certain strategy. So it's difficult to improve a strategy that you don't really implement. A mindset fundamentals create the foundation for emotional control, discipline, patience, proper risk taking, consistency in following plans, clear decision making during volatile markets. In trading, psychology of influences result as much as analysis, even more than the analysis itself. So clearly, a strong mindset is the foundation of every successful trader. And by the way, this subject is repeated for many traders are asking, and even if they are not asking, it is clear that this is something that they need to constantly work on and improve, because sometimes the analysis is very good, but the other side of the psychological factor is causing to enhance odds of losing capital. So here we will discover we have the fear versus greed. Fear and greed are the two strongest emotions that influence trading decisions. They often push traders away from their plan and into emotional, impulsive trading behavior. Fear shows up as hesitation to enter good positions, closing winning trades too early, avoiding opportunities after a loss, exiting positions too quickly during volatile markets. Greed shows up as increasing position size after a win, holding trades for too long, ignoring stop loss rules, chasing fast moving markets without a plan. A balanced mindset will help traders to avoid emotional extremes and make clearer, more consistent decisions that we will be discussing today. FOMO, fear of missing out. FOMO is one of the most common psychological traps in trading. It pushes the traders to act emotionally instead of following a certain plan that they set in advance. How FOMO appears entering trades too late because the market is already moving, jumping in without confirmation or analysis, copying other traders or reaching instantly to news, feeling pressured to not miss the move. What causes FOMO? Seeing big candles or strong momentum, watching other make profits, react, and recent losses of frustration, lack of patience, or confidence in a strategy. FOMO leads to impulsive entries, poor risk management, and inconsistent trading results. Traders reduce FOMO by trusting their plan and accepting that missing a trade is perfectly fine. Discipline and patience. Discipline and patience are two of the most important skills in trading. They allow traders to follow a plan, control emotions, and avoid impulsive decisions. What discipline means: following your strategy consistently, respecting stop loss and take profit levels, keeping position size under control, avoiding revenge trading after loss, not trading when market conditions are unclear. What patience means: waiting for high quality setups, not trading out of boredom or frustration, allowing trades to develop without micromanaging, accepting that not every day offers good opportunities. and basically means following your strategy. Traders who develop discipline and patience create long-term consistency and avoid emotional mistakes. Common emotional triggers: sudden profits or losses, large market movements or volatile markets, a losing strike or a big win, personal stress, tiredness or distraction. Um, how emotional triggers affect traders: overreacting to short-term price movements, closing trades too early or too late, increasing position size emotionally, entering trades without analysis, breaking risk management rules. The reason why we are obviously discussing this subject, so for you as a trader, and I'm sure that some of you who are listening today are familiar with this concept, and it already happened to you before when trading, and we are discussing them today. So each one of you can work on it and improve your uh, psychology of your trading and become more consistent with your plan and with your strategy. And now we're going to cover risk perception, why risk perception matters. Traders often underestimate the danger of large positions. High leverage increases emotional pressure and stress. Smaller position sizes allow clearer, more rational decisions. Here we're talking about risk appetite, that you should determine in advance how much money you approximately want to lose on a trade, and what is your potential exit point if the position is profitable. So if you determine in advance an amount that you feel comfortable to lose per positions or to lose in total, you are the one that can decide how to navigate your account accordingly with the correct lot size. That the lot size determines the profit and loss you're going to have per each point the market moves. So if the lot is higher, the profit or loss approximately per each lot size that you choose. So it can be higher or smaller. And now how poor risk perception shows up: overconfidence after winning a position. So you're feeling very confident after a good position that you have, and then it can cause you to make mistake because of that position that was profitable. Taking larger positions to speed up profits, so you take a bigger level of uh, risk on a position, you take a bigger position size, ignoring stop loss levels. You set stop loss and then you ignore it, you either remove it or you don't set the stop loss in the first place. Believing a trade is safe based on emotion and not based on analysis. Before opening a trade, you should know why you are opening the position, and you should have a certain foundation and strategy for opening positions. And even if the strategy is not good, you can always learn how to perfect it and improve it as you go. Healthy risk perception means respecting position sizing rules, which means, as we mentioned, the risk appetite. So you know what is your risk level, then you can calculate what is the lot size you want. The minimum lot is normally 0.01 lot. On MT5, we also have nano lot, which is 0.001 lot. Another zero for nano lot. Understanding that losses are part of the process, managing leverage carefully, making decisions based on probability and not based on emotions. And we have confidence against overconfidence. Confidence is a trader's ability to trust their strategy and follow their own rules. Overconfidence appears when a trader becomes too certain, ignore risk, and stop respecting their plan. What healthy confidence looks like: following your trading plan consistently, taking trades only when your setup appears, respecting stop loss and position sizing rules, accepting both wins and losses calmly. What overconfidence looks like: increasing lot size after a win, taking trades outside of your strategy, ignoring stop loss levels, believing the market won't go against you. Why this matters: confidence leads to discipline, stability, and long-term consistency. Overconfidence leads to larger losses, emotional decisions, and broken rules. The reason why you set rules, so you will be able to have a certain discipline in your trading that will allow you to be more successful in your trading journal. A balanced trader stays confident without letting success turn into recklessness. Revenge trading: entering new trades immediately after a loss to win the money that you lost back. Sometimes it can cause you to lose more money because you are very emotional after losing money. Overtrading: taking too many trades, trading out of boredom or forcing setups. Moving stop loss level, adjusting your stop loss further away to avoid taking a loss, increasing stress and risk. So basically, after you already set your stop loss, then you decide to ignore your strategy and change it after that you've already set it. Closing a winner too early, selling profitable trades too quickly due to fear of losing gains, letting a loser run, holding losing trades and hoping they reverse instead of respecting your rules. So you set a certain loss exposure and then the position goes into negative, and instead of closing the position with the loss that you set, you um, decide keep to keep it going. Impulsive entries: entering trades without analysis, confirmation, or a clear plan. These mistakes are common among both beginners and experienced traders. The key is recognizing them early and building discipline to avoid these mistakes. Common trading mistakes: emotional control tools helps traders make logical decisions instead of reacting impulsively. Simple techniques reduce emotional trading and improve consistency. 5-second pause rule: pause 5 seconds before entering or adjusting a trade to break emotional impulses. Uh, Breathing reset: slow, deep breath, calm the nervous system and reduce stress during volatile markets. Cool down periods: take short breaks after a big winning or losing to avoid revenge trading or over confidence. Structured decision making: use checklist or rules to avoid key questions before entering a trade. Emotional detachment: treat each position as one of many, not something personal, to reduce emotional pressure. These tools help traders to stay calm, focused, disciplined, even in fast market. Routine and discipline: strong routine and discipline habits help traders stay consistent and avoid emotional decisions. Good trading is built on structure, not on luck. So it's very important to build a certain discipline and a certain routine that will allow you to follow your strategy and then to be more consistent with it. A pre-market routine, review market conditions, key levels, and planned setups before the trading begins. Journaling your trades, record entries, exits, emotions, and mistakes to identify patterns and improve over time. Daily loss limits, set a maximum loss for the day to prevent emotional and reckless trading. You can do that by calculating in advance what is the amount of money that you want to limit your loss to, and then either you can set a stop loss or you can just close positions when it reach that certain point. Consistency habits, follow the same rules, time frame, and process every day to build more stability. Sticking to your plan, execute only when your setup appears and avoid trades outside of your strategy. Routine and discipline allow traders to stay focused, avoid impulsive behavior, and build long-term consistency. Case studies, real trading examples help traders understand psychology influences results in practical situations. Psychological failures, a trader increases a lot size after win, becomes overconfident and takes a large loss. Another trader moves stop loss repeatedly, turning a small controlled loss into a big emotional one. Discipline mistakes, a trader enters multiple trades out of frustration after a losing strike, leading to overtrading and more losses. Another trader exits winning trades too early due to fear, missing long-term profit opportunities. Success through disciplined trader follow their plan, respects stop loss, maintain consistent position sizing, leading to steady and long-term results. Another trader journals each position, identify emotional triggers, and reduces impulsive decisions over time. So the key lesson here, the strongest traders are not those who predict the market perfectly, but those who control their emotions and follow the rules consistently and always keep changing your strategy accordingly and perfect it. So we have here a subject that I personally like called trading journal. Keeping a trading journal helps traders improve self-awareness, discipline, and decision making. What you should record: entry and exit, price setup, reason for entering, risk, stop loss, position size, emotions that you had before, during and after the trade, mistakes made or rules broken, what you learned from the position, why does it matter, identifies emotional patterns, help avoid repeated mistakes, build confidence in your strategy, improve consistency and discipline. A trading journal is one of the most powerful tools for long-term psychological improvement. Many traders that are trading are not really using that tool of journaling their trading journey, and it is very important because it's very, very simple. You can do it in a Word file, you can do it in an Excel sheet, you can do it in a notebook, and it's not very complicated. You can just set the different rules that based on these rules you decide whether you want to open a trade or to close a trade, and then you need to decide when you want to cut your losses. You can also do it in advance and set your stop loss and set your take profit. And this is very important and helpful, and it can assist you with your trading psychology. So it will be better and better, and at least you know that when you are trading, you have a certain setup that you follow before trading and while trading and after trading to analyze as well what you've done wrong and what you can improve for the future. So, for example, you have a certain uh, division that you can do. Okay, for example, here it says daily and then weekly and monthly and every quarter. You decide how you want to break it down. So, trade, okay, euro dollar, for instance, it was a long position and you can do a long or you can do a short, the date it was open, the setup, okay, why you basically open the position, what was the entry, what was the stop loss, what was the take profit, what was the position size, reason for entry, emotions, outcome, mistakes you've done, the lesson that you learned, and you can add more and more things. For example, you can add what is the risk exposure of the account in terms of percentage, or if the position will hit the stop loss that you set, what is going to be your loss approximately. Okay. By the way, in AVA, we do not have a stop loss guarantee, which basically means that if you set a stop loss, the system will try to execute closure at the price that you set, but not always it is possible for the system to close it exactly at that price, so it will close at the next available price. But it is a good measurement to know when the price of euro dollar hit the stop loss level, what will be your approximate loss. And then we have a weekly summary, total positions, win-loss ratio, main mistakes, main improvements, goal for next week, a monthly summary, win rate, monthly rate, strength and weaknesses, psychological progress, a yearly summary, annual growth, best or worst month, biggest lessons, focus for the next year. Another example for weekly trading journal, you mentioned the week, the total positions, the win-loss ratio, the main mistakes that you had, main improvements, the goals that you have for next week, and here you can add things that you think that will help you to improve for your next week. For monthly trading journal summary, you mentioned the month, the win ratio, the monthly return, the strength, the weaknesses, the psychological progress. For example, the yearly trading journal summary, you mentioned the year, the annual growth, the best month you had, the worst month you had, the biggest lessons you learned, the focus that you want to have for next year. And now we will be focusing on Q&A and connecting psychology to real trading, answering questions that you have, address common challenges, fear, hesitation, overtrading, impulsive decisions, clarify psychological concepts with real examples, applying psychology in real trading, show how to use routines, discipline, risk management, emotional control, explain how these tools improve decision making in live markets, improve daily habits, encourage journaling, reviewing mistakes and tracking emotions, help traders stick to their trading plan and consistency, practical follow-up steps, invite traders to future webinars, share educational resources, recommend tools that support better trading discipline, and Q&A to help the traders to bridge the gap between theory and practice, leading to real progress and long-term consistency. So basically, we have touched a very important subject today related with what is psychology of trading, what are the main factors that can cause to a good psychology and a bad psychology that can cause you to inconsistent trading results. It is very important to focus not only on the analysis itself, which obviously analyzing what will happen to the value of the asset is very important, whether you think the value is going up or whether you think the value will go down. This is very important to do the analysis. But the other part, other than the analysis, is the psychological side, where you decide whether to place an order or not to place an order, and after that you have done that, you are basically journaling everything and making sure that you have indeed followed a certain plan. So if I will be asking traders what is their profit and loss on a weekly, on a daily, on a monthly, on a quarterly, on a annual basis, not everyone knows. Not everyone knows what is their risk exposure. So when they are trading, they don't know how much money they can lose, or how much money they are planning to make, or what time they are planning to trade. So things needs to be structured in a way that will allow you to trade the feeling that you are in control. And this is the reason why we have this webinar, to get you a little bit more into control your trading and be more familiar with the main things that causing you to be out of control. And even if you are losing X amount of money, as long as it is within the plan and the psychology settings that you have initially set, so at least you know that you are following a certain plan that you have set in advance, and you are following a certain discipline that you have. And now we will discuss the subject of an account manager. The benefits of working with an account manager is that you have someone in AvaTrade that you can reach out. Normally, account manager, you need to have a certain threshold above $1,000 to have an account manager. And we also have different VIP account managers that also you can get when having a bigger capital above a certain threshold. And the point of having a account manager is for you to be able to communicate with someone. You can ask questions, you can schedule calls, you can have one-on-one calls where you discuss different things regarding the platform. They can help you to get more familiar with our platform and the major things that you should be familiar with when trading, and personalized calls from someone that have experience and someone that have been working with many clients. So this is something that you can use also as a tool, and it can also help assist you with your trading journey. And this is the presentation that we have just gone through regarding the psychology itself. Now we can continue discussing a little bit more regarding the website itself. Now we'll be sharing with you a few more things. So in terms of what we have discussed before, how to place an order, how to close an order, how to calculate profit, how to calculate losses, how to set a pending order, how to go through your trading history, all of that we've already discussed previously in our previous webinars. And so now we will be discussing a little bit more about the charting itself, that we have started going through that a little bit more on our previous webinar. So once you have this decided whatever you want to trade, you have different candlestick charts. Each candle represent the time frame that you have selected from 1 minute to 1 month. The bigger you go, the more time you will be able to see over here. So for example, if you click on the cursor, you can see here it goes up to 18th of December, which is today. But if I change it dramatically to the monthly, you can see it goes up to 2014. So it's a big change. And you can change it from 1 minute to 5 minutes to 15 minutes to 30 minutes. You can change the candles and decide for yourself what is the most relevant time frame for you. You can change between the time frames, and then you can identify different patterns on the graphs. So for example, here when I look at the hourly candle, I can see for the 11th of December until today, you can see the price of AUD CAD. You see here was around 0.91820. It was the open, and the high price was 0.92020. And you can see the top of the price in the hourly chart to 0.91256. This is something that you can use to identify a certain pattern on the hourly chart, okay? And you see the value indeed went down. And if you change it to 2 hours, it's going to be a whole different charting. And you can see also where in that time, here it goes up to the 3rd of December, which is a little bit further away. And you can see the price went up to 0.92503, and it dropped down up to this. So basically, I'm sharing this because a lot of people are not always very familiar with the way the candlestick charts can show us the history of the graphs, and we use the history in order to identify what may happen in the future. This is more of a technical side of trading, that you do analysis of technical. You identify what you think will happen based on the past. And on the WebTrader, we have different tools that you can use. You can see here you can have different type of visibility features. Here you can set different kind of indicator, for example, Bollinger Bands, MACD. So you can set them up and then you can save them. And also you can set your settings. If it is Bollinger Bands, you set them the way that you want. We have here different features like trend line, price line, oval, and so on. So this is the graph that you see, the visibility that you can see on our WebTrader. You can open also a few charts at the same time, and this is just something that I wanted to add extra because of the importance of it. And basically today we covered the majority of the webinar about the psychology. Then we went through a little bit of a candlestick charts that surely we'll be able to go through further in our next webinars. And I hope everyone enjoyed listening to the webinar we had today. And in the future, you can visit our weekly webinar. We have it every Thursday, and you can ask more questions or get more involved with the previous webinars. You can visit our YouTube channel and just go through the webinars and make sure that you are familiar, because every webinar we will be discussing something new. Next webinar we'll probably go through the MetaTrader a little bit more, or our app, MetaTrader app or AvaTrade app. And that's all, everyone. I wish you a successful and fruitful trading journey with AvaTrade. And I hope to see you again on our next webinar. All the best, everyone.